Good morning. This is the Haskayne Hour, and we are very religious about getting this timed so that you are out within an hour. We will feed your body and your mind within 1 hour. This morning, we are talking about the broken IPO market, and we have a finance professor, Ari Pandas, coming to talk about his research on IPOs. He's in the Haskayne School of Business and has done a number of media interviews and written a number of publications on this. We also have Michael Lang, who is the chairman of Stonebridge Merchant Capital Corp, and he serves on a number of boards throughout the city, both in the private and in the public and in the nonprofit. And currently he is serving on a GPS company in the ag industry. All right, I'll turn the stage over to the two of you.
Thanks, everyone. Thanks for coming out on a chilly December 1st morning. I don't know about you, but this is early for me, as people that know me know. So I'm very fortunate that I have a very intelligent co-host who will actually carry the morning for us. Okay, I'm going to put you to work right at the beginning of the morning, and I have two cases to bring up. And the question is to IPO or not to IPO. So I'm going to go through those two cases, and I'm going to ask you a question as to whether you think these companies should IPO themselves or not. So the first case is an experienced oil and gas president. He's had two successful companies in the past. He's very well known as a credible management team, and he wants to raise over $100 million. So my question to you is, how many of you would not IPO? Raise your hands if you would not IPO, you would do something else. Okay, so roughly half the crowd. Okay, let's go to the second case. Second case is a technology company. President's really been successful in the past. His last venture, he went from $0 to $20 million market cap within 3 years. And now he's starting up a new company, wants to raise $1 million. Raise your hands if you would not IPO and you would do something else instead of IPOing. That's the majority of people. Okay, so now we're going to go through the intelligent part of the conversation, and then we're going to come back to these two at the end, and we'll tell you what actually happened. I'll turn it over to Ari.
Great, thanks, Michael. So I'm an academic. This is way too early, so I'm going to stay seated for this portion here. So I've spent a lot of my research career looking into IPOs in the capital markets. So I thought today I'd bring in some slides that I've developed over time and talk about some of the insights there. So just motivating the discussion. You know, there's a lot of chat in the US about the declining IPO market given the size and scope. It receives a lot of attention. So I pulled some data from Jay Ritter, who's an IPO guru in this space. And what he's documented, and many others have documented, is there's been this steep decline in IPOs since about 2000. So you can see in this graph here, from the period 93 to 2000, there were about 458 IPOs per year, and it's declined to about 111 IPOs per year since. And if we drill down a little further, it seems to be that the precipitous decline is being with the small cap IPOs mainly, although the large cap have also declined. So in this graph here, the small cap IPOs are represented in blue, and then the large cap are represented in red. And you could see that the small cap have declined much more heavily than the large cap, although both have declined since about the year 2000. So what about Canada? So as I mentioned, very little research is done on the Canadian capital markets. A lot of people don't know about the health of the IPO market in Canada. So I pulled some stats, and I'm only looking at operating company IPOs here. So I've excluded REITs and ETFs and other forms of trusts. And what you find is a similar trend, actually. So if you look from 93 to 2000, and since, you could see a drop-off in the number of IPOs here in Canada as well. And if you look closer to home, energy IPOs, you find maybe not as stark trend as the overall market, but you also find a decline. And it's a little more important in the sense that if you look at the 2000s, we had unprecedented rises in the prices of nearly every commodity that Canada produces. So to see a decline in the recent period is actually a little more surprising in my mind. So I've also pulled some stats. If you're not happy with graphs, you can look average number of IPOs per year from 93 to 2000, about 41. And then from the 2001 to 2015 period, it's about 16. So a steep drop, right? About half, less than half of the previous period. If you look at the average number of energy IPOs per year, and again, these are operating company IPOs, you have about 5.3 from 93 to 2000, and then in the period since, you have about 3. So again, that's quite telling in that we had huge rises in oil prices and other commodity prices in the early to mid 2000s. If you look at the average aggregate IPO proceeds per year, you have about 5 billion on a per year basis from 93 to 2000, and then 2001 to 2015, it's about 2.2 billion. And that's also telling in that that's a lot of dollars that aren't being raised that could potentially be invested, could be contributing to jobs, tax revenues for governments. So lack of proceeds from the IPO market can be seen as a problem. And then if you look at the average median IPO size, so companies going public seem to be larger these days. And that's consistent with the US evidence, where the companies that are seeing the biggest hit are actually the small cap IPOs. So larger companies seem to be going public these days, raising more, and it's the smaller companies that seem to be facing that crunch. So we have a paper, myself, Bryce Tingle, whom some of you may know, in the law school at U of C, and Michael Robinson, a colleague of mine in the finance area. And what we did is we sort of looked at some of the reasons that are cited in the US market to see if it applies to Canada and sort of pick them apart. And if those reasons don't apply in Canada, then we felt that something else must be going on in Canada. So the reasons you often see in the press and among academics and industry players in the US, the first obvious one is regulatory overreach. So in the early 2000s, Sarbanes-Oxley came in. That increased compliance costs for a lot of companies, and that disproportionately hit the smaller cap companies. So that's one argument that you see floating around as to why we've seen a large drop-off in US IPOs, particularly on the small cap space. The second argument is the US litigation climate. So basically, the culture in the US seems to be more litigious. You have fiercer prosecution, and for that reason, companies don't want to be public and potentially face the liabilities that go along with being a public company and facing potential litigation. The third reason you see is changes in market structure. And what I mean there is basically there was this trend starting in the late 90s of reducing tick sizes, right? So decimalization. And that essentially made it less profitable to make the market for smaller cap companies. And hence you saw a smaller amount of small cap IPOs because it just wasn't as profitable for the smaller mid-tier investment banks. And you saw a lot of them actually disappearing from the market. And those were traditionally the ones that were supporting the small cap IPOs. And then you also had other things like regulation fair disclosure, as well as the global settlement, where Elliot Spitzer was hard on that in the US and wanted to separate investment banking from research. And then lastly, this is a more recent argument or hypothesis that's been floating around. And I would say mainly applies to the tech sector. So basically, there's a fundamental shift in the economic landscape. So smaller companies, particularly tech companies, are less profitable. Speed to market is key. Larger companies have economies of scope and scale. So the model has changed where now small companies, instead of going the IPO route, are just selling out to the larger players, so like the Facebooks and the Microsofts and the Apples, rather than wanting to actually go public. So what about Canada? So what we do in that paper is basically pick these reasons apart, right? So again, I'll go back to these reasons. We did not have Sarbanes-Oxley coming in Canada, right? So we didn't have the rigorous and expensive compliance costs associated with that. So we can sort of discount that argument in Canada. We don't have as fierce a litigation climate in Canada as the US. So we don't feel that that's really an argument that applies to the Canadian case. We also had a reduction in tick sizes, decimalization, but our mid-tier and boutique investment banks didn't disappear like they did in the US, although some may argue in the last couple of years, and you've seen this in the press, that some of them are hitting harder times, but I think that's a little more cyclical perhaps. And we really don't have a vibrant tech sector where this fundamental economic change, economies of scope hypothesis really applies. So And I'll add, we've seen huge increases in the prices of all these commodities that Canada produces, and we're still seeing a decline in the IPOs. So we propose what's known as the public market pressure hypothesis. And what that says is, we've spent a lot of time over the last 10, 20 years trying to align the incentives of management and shareholders, right? Getting managers to act in the best interest of shareholders, the classic agency problem, the principal agent problem. So the question is, have we created an environment where shareholders are putting way too much pressure on the management team? You have much more activist short-term shareholders these days. They're much more hostile. They scrutinize every move and decision management is making. And the question is management just fatigued with the public markets, and are they wanting to stay private to avoid all the stresses that go along with being a public company? And there's some anecdotal evidence of that. So if you look a couple of years back in 2013, there was a few quotes in the press when Randy Arisman, the former CEO of Encana, retired abruptly. The reason he cited was actually fatigue with the public marketplace. There was also a study done, or a survey done in Fortune magazine, basically saying, surveying CEOs and saying, would you rather be a private company or a public company? Where do you face less pressure? And by and large, more than 75% of them actually said we would rather be in the private marketplace, where we can focus on business rather than dealing with all these external gatekeepers and regulators and the stresses and the pressures that go along with management. So that's a hypothesis we propose, and that's from the research side. But I thought it'd be a perfect opportunity to pick an industry player's brain and to see if that makes sense. Is there more public market pressure that CEOs face? And is that maybe a reason why some CEOs would rather not go public and stay private?
Yeah, no, I think that's certainly the case. The companies that I've been involved with, the president of the company might spend a third of his time marketing the company to shareholders, and he doesn't have to do that if he's private. So as you said, not only is it the management group, but also the major shareholders. They want their president running the company as opposed to talking to a lot of shareholders. It takes away from the effectiveness of the company. So those are huge factors. I think the other big factor is, as all of you know, the exchange-traded funds, the ETFs, are becoming more and more prominent within the industry. And for those of you that don't know, ETFs are basically a collection of stocks that are not selected other than by the criteria that are mandated within the stocks. So the TSX 60, for example, would be the 60 largest stocks within that ETF. And a lot of people would buy that because they would then ride the market without having to pick individual stocks. So ETFs, by their very nature, are not then inclined to want to buy IPOs because they're buying an existing mandate. The other corollary of that is that a lot of brokers are going to managed funds. So they're going to take your money, they'll take your $100,000 and they'll charge you a set fee, 1% or 1.5%. And for those types of situations, there's no incentive for them to buy an IPO. They want to show you that they're buying a basket of funds without running the risk of IPOs. So as I talked to a broker last night, he said from his perspective, individual stock picks are dead. They're more and more mandated to just buying a basket of stocks. So again, all of these factors would dictate that there's less money available for new IPOs coming into the market.
So the question is, if the IPO market is down, what are some alternatives that companies could be looking at in that space? So clearly, private market financings is one. So if you think about private market financings, these are private companies. So if they want to issue securities, they've got to do so through some exemptions. So some classic exemptions are friends, family, business associates. And another one is you've got to be an accredited investor, so you've got to meet some threshold of net worth and annual income. Another one where Alberta actually was an early adopter of this, and Ontario just recently adopted this, is an offering memorandum exemption. So this is an information document that a company in the private space would be able to produce, and then by doing so, they can tap into regular retail investors. Because the classic problem in the private space is that retail investors cannot participate unless they meet one of these exemptions, and oftentimes they don't. So this offering memorandum exemption that came in Alberta many years ago allowed regular retail investors to participate. So I've done a little bit of research on that. The ASC, and I saw there's a couple of members in the audience here from the ASC, they were generous enough a few years back to give us access to some of their database in a confidential and discreet way, obviously. And it's a pretty sizable market. So we looked at a 4-month window in 2006, and companies raised in the private marketplace about 1.4 billion. Large percentage of that was from accredited investors. And you also have dealers playing in that marketplace. Some classic investment banks for the better, larger deals, as well as some exempt market dealers that help facilitate the raising of capital and access to capital for smaller cap issues. Now, some companies are fortunate enough to get venture capital and private equity, and this is Michael's bread and butter. So I'll let him talk a little bit about the private equity and the venture capital space and what that means in the Canadian market.
So to give you some stats, over the last few years in Canada, of the money that's been raised on a private basis, roughly 20 billion has been private equity and 2 billion has been venture capital. And the distinction between those is a little bit blurry, but that gives you relative size. And as Ari mentioned, the IPO size was between $2 and $5 billion. So it gives you an idea of the relative size of the IPO market versus the private equity market. And again, the question is, why do people do the private equity side? They get the expertise of the people that are involved. So when we invest in a company, we spend a lot of time and effort with the company to help make them successful. In the past, companies wanted to go public because they wanted to control, the management group wanted to control what they were doing. They didn't want the outside influence of shareholders. Now in the tougher market, they actually like having a lot of companies like having large shareholders that can give them advice and guidance and help them take themselves to the next level. So yes, that's a very major factor.
Yeah, and it seems like the human capital side is critical in venture capital, where you actually play an active role. You might put your own management team in and take board seats and really guide and coach the company in that process.
Yeah, totally. Within Stonebridge, we're small. We've been around for 15 years, but we budget 1 man year between the 3 of us when we get involved in a company. And a public company doesn't get that. So it's basically, for us investing in companies, it's free advice for them during that period. And of course, we have a strong vested interest because we're major shareholders in the company. And again, public companies don't get that. They circumvent that, not circumvent. They use boards of directors as a way of getting around that. But a board of director meets 6 times a year and tries to help out with the company. It's not the same as somebody that's put their own money in or is mandated to manage money to be involved in a company.
Yeah, sounds good. And I guess there's other options as well. So, we often think of government being hostile toward business, but there's actually quite a few government grants and support mechanisms that exist in Canada. And if you look around, Canada has actually a pretty generous grant and support system for businesses, particularly if you compare it to some OECD countries. So, at the federal level, we've got programs like IRAP and SHREDS, which provide tax credits to companies investing in research and development. And that applies across industries, but particularly generous towards the tech sector. In Alberta, we've got similar programs. In addition, we've got the Alberta Investment Tax Credit. So if you invest in particular tech industries, you can go on the website to see what applies. But as an investor there, you can actually get pretty generous credits. There was an interesting study done by PwC, actually, that said more than half of the companies don't even utilize government grants and support. And I think part of that is just awareness. A lot of people don't know necessarily about the government grants and support systems that are available to them. Another aspect might be, and I can sympathize with this, as a researcher, I apply for a lot of grants, and they're quite tedious and time consuming. So if you're running a startup, it could be quite timely and time consuming to actually put a grant application in and start researching different government programs that are available to you. There are some grant consultants around. So Alberta, Boast Capital is an example, and there's some others as well, where they will help you, guide you through the process of applying for government grants and seeing what might apply in your particular circumstance. So there's a good website I put up there, canadabusiness.ca, that actually provides a lot of information about grants and support from the government. Thirdly, crowdfunding. So this has become pretty popular of late. Basically because of technology and the internet and how companies now have access to a broad base of investors. So to be honest, from an academic perspective, I'm a little skeptical about crowdfunding. So you saw some of the stats sort of coming up before the presentation. So it's grown to about a $30 billion industry worldwide. So the classic problem I see there is an information problem, right? So regular retail investors can now participate in crowdfunding. There's been some rules that have been put in place. But I wonder if it's going to end up being a lemons market, right? So if you're a good company, good prospects, you would probably attract angel investing. You would attract maybe VC, some sophisticated capital. So you worry, are you left with sort of the lemons in this marketplace? Secondly, you worry about fraud. You've got regular retail investors participating in this marketplace. I know we've got some rules and regulations in place, but you wonder if regular retail investors are doing the proper due diligence and analysis in seeing whether these companies are viable and able to even determine whether their prospects are good or not. And I think another important issue is liquidity, right? So in the private marketplace, you really don't have a lot of liquidity. So if you buy shares and you hit a liquidity crunch or a cash crunch, you're gonna have a hard time selling those shares to other investors, right? So it's not a public marketplace where you can easily buy and sell securities. So those are some of the classic problems I worry about in the crowdfunding space. And I'll add there's different forms of crowdfunding, right? So you've got donations-based, you've got rewards-based, you've got lending and equity. So the place I'm most worried about it is in the equity side. I think donations and rewards are not as big an issue. To some extent, lending is not as big an issue. And that's actually the majority of the crowdfunding space. I think actually a better version of that is actually the venture exchange, right? So the venture exchange allows regular retail investors to participate. You've got the checks and balances of the commissions, of the stock exchange. You've got to meet certain listing requirements. But importantly, regular retail investors can participate and they've got some liquidity. So I think that's a place that gets unnoticed around the world is the vibrancy and health of the venture exchange. And there's a lot of opportunities for very early stage companies to raise capital. And we've had tremendous success with that. And I think a lot of people don't know about it. Sometimes I teach this in my MBA class and I say, do you know about the TSX Venture? Do you know some of the programs that are available? And I rarely get hands being raised. So I think I can provide some statistics around that. So I mentioned that the senior market IPOs are down. But if you look at the venture exchange, we've had a pretty healthy IPO run. So I plotted data from 93 to 2015. You can see, in 1997, you had about 234 IPOs. In 2007, you had 230, and pretty healthy along the mid-2000s as well. It's only in the last couple of years that we've really seen a drop-off, which is a cause for concern, but I think it's one thing where we should notice it and maybe adapt rules and find ways of supporting the venture exchange, because it has been, particularly in Alberta and BC, where we're starved oftentimes for venture capital, an opportunity for companies to access capital. And I'll talk a little bit about the different types of IPOs there. I put in red the regular IPOs and CPCs. And CPC is a program that originated here in Alberta and has had a lot of success. And I'll talk about what that is in a moment. So to give some context about why we have something that's really special here in Canada with the venture exchange, I have a study or a book chapter with a colleague of mine, Michael Robinson, where we look at junior exchanges around the world, particularly in Europe, where they've toyed with the idea of junior exchanges, but have not had much success. And just comparing the period from 95 to 2009, you can see that we've had over 2,000 IPOs in that period. You look at Paris, Euronext, about 725. In Germany, 461. In Italy, pretty much nil. The closest competitor, I would say, is London's AIM. And they really peaked and had a good run in the 2004 to 2006 period. And you can see they dropped off quite a bit since, whereas you look at Canada, we've still had a healthy IPO market in that space. So we've got a nice gem here, I think, in the TSXV that allows companies, early stage companies, to actually raise capital through an early IPO. So I mentioned the Capital Pool Company program, and so I'll just briefly mention what that is. So that originated here in Alberta. It was called the JCP, and then subsequently over the years, other provinces adopted that. There's some interesting history around that. At the time, when you looked across the country, a lot of people out east said, this program's crazy, it would never fly in any other market. other than in Alberta. You guys are cowboys out there. And it's since been adopted actually across the country because it's been such a big success. So here essentially you have a bunch of founders that raise some cash. It's got no operating business, just a cash shell that has a couple of years to go out and find a transaction, which is called a qualifying transaction. So that'll be either an asset acquisition or a reverse merger of some sort with a private company. So it's an alternative way for a private company essentially to go public. And it offers some flexibility because it's actually exchange regulated rather than Securities Commission regulated. And there's some speed that you can get to the market with that. So you can see a lot of the IPOs on the venture have actually been CPCs. And the goal, of course, of the TSX is to actually graduate eventually to the senior market. So we have a cute paper that's a working paper now, does spending miners in the payoff, spending time in the miners pay off. And essentially we find that companies that do graduate, that first go the TSXV route, actually perform quite well once they do graduate to the senior TSX market. And you can see it's been a nice feeder market into the senior market. So although IPOs on the senior market are down, what may go unnoticed is the fact that there's a lot of graduations that feed into the senior market. So bringing this back full circle, to where we first started, to IPO or not to IPO that Michael posed, the case 1 and case 2, I'll leave it to him to sort of tie it back to the very beginning.
Sure. So we went through these initial 2 cases. Again, the first one is an oil and gas company. The gentleman's raised money with 2 successful companies in the past. And the question is, he wants to raise over $100 million now. Should he IPO? And I can give you the answer, but I would prefer to have the president of the company, Bruce Schultz, stand up and give some comments as to what you actually did, Bruce, and why you did what you did. There he is, Bruce.
Well, I stayed private. So I'm a geologist by background, not a financial person, and the reason, so yes, we had 2 successful companies, and I did get asked by a lot of people to go public, and even the remuneration for that could have been quite good for me, but I'm more of a scientist than and I enjoy the science, and I enjoy the search for new hydrocarbons, which is what we do. We try to find new things, not buy existing production. And in that, there's an awful lot of upfront science that goes into it, a lot of testing. We're trying to find new accumulations using existing technology, but there's an awful lot of science. And so the original successes you can't measure on a financial statement. You have to, there are different measures that are telling you that you're making your progress to your final goal. And so having a very knowledgeable investor, like a private investor, like someone like Michael, or ARC Financial in our case, they're working alongside you, and they help you find your way to that, to the promised land, hopefully. But so yes, we would be crucified in a public market, and it's far too distracting to what we're trying to accomplish as a company.
Thanks, Bruce. Okay, let's look at case 2. Again, experienced technology president, previous venture goes from $0 to $20 million, wants to raise $1 million. So we talked about CPCs and other small public ventures. Did this company go public or did they stay private? Hanif, where are you? We're putting Hanif up on now. There's Hanif Jashigami.
Thanks, Mike. We also stayed private. There's a lot of reasons for that. One is the public market, even CPCs are too costly. I mean, we did our financing in less than a month, and it was just legal fees. So it's like less than 10 grand to get it going. For a small startup, especially in the tech space, it just makes a lot of sense. There's a massive tech ecosystem in the private market, and it's blown up in the last 5 years. There's a huge amount of private capital liquidity that doesn't exist in the public market for us, especially in Canada. The public market doesn't really get our space quite yet until you're like $500 million or more. Then there's a couple of other things. Again, the low liquidity even after you go public, the main benefit of going public is if you have liquidity, but if you have zero liquidity in the public market and the smallest transaction can move your stock, what's the point, right? So it just doesn't make sense for us. And yeah, it's less volatility to short-term ebbs and flows. Like if you have a strategic partner that's looking just to the exit and, you know, operational milestones to the exit, it's a lot better than, you know, retail investors that can move your stock with every ebb and flow. So again, it doesn't make sense for us, especially because lots of R&D, almost no revenue initially. So it's things that retail investors don't quite get or appreciate. And the other thing is, you know, we're a tech company. There's a lot of proprietary stuff there. We don't want that in the public space if we don't have to. So we want to try to avoid reporting as much as possible. If you have a strategic investor and you have to give them stuff, you will. But other than that, you try to keep it as tight as you can. Then basically, the investors are strategic. I mean, they've invested into tons and tons of tech companies. They normally help you fill your board. They help you get access to clients. They actually opine on how you execute your plans. So especially as a small company, you want that. And we actually, the investors that we picked strictly for their strategic value versus the amount of money that they were going to put in. And then speed, which I mentioned in the beginning. Just your comment, I mean, whether you're public or private in the tech space, there's a huge amount of like free grants that you can get as a tech player. The tech companies know all about it. I don't know of a single tech company that doesn't do it. Our business, we're probably gonna get 2.5 times for every dollar we raise, we're probably gonna have $2.5 of hard spend, just from all the different grants if you stack them on top of each other, right? So it's actually, especially in Alberta now that they're trying to diversify, it's a really good space for us. So that's it.
Right. Thanks, Bruce. Thanks, Hanif.
At this point, I'm going to turn it over for Q&A, and I'm sure there's a number of questions in the audience, but I am going to start with the questioning. Ari, if you were a young entrepreneur sitting here with a great idea, what's the kind of the takeaways you would want them to have today?
Well, you know, a couple of things. I think the one thing is we have a lack of research, I think, into the Canadian capital market, so that's critical for an entrepreneur to have access to some of what's going on, what does the Canadian marketplace look like in terms of access to capital. So I think we're sort of research starved in Canada, and I think there's room for further analysis on that. I think from the regulatory perspective, and I think Alberta's been very good at this, is you want to be adaptable. So you want to figure out, you know, what's working, what's not, and make changes that make sense for the times and for the different industries. And I think those would be the two main takeaways. And lastly, you know, these are important issues. And, you know, a healthy public market is very important for economic growth, job creation, and as well as just allowing people to invest, right? So a lot of regular investors don't have access to the private markets, and if you're thinking about saving for the future, the public markets offer that opportunity. So I think it's important to support the public space as well as the private space, but not sort of dismissing the public markets, because if we had a system where everybody was staying private, then a lot of people would be shut out of that marketplace, right? So I think that ends up being important as well.
Okay, Michael, do you have some takeaways?
I agree with Ari, but I think we are seeing a decline in the public markets, and I think what is happening is good ideas and good management groups will always get funded, and they'll get funded through other means, and that's why we're seeing the crowdfunding, the private equity, and the venture capital expand themselves. So I think if you have a good idea and you have a good management team behind it, there's ways to get money.
Okay, so what I'd like to do is open up the floor to questions and answers. And we've also, if you have a question for Bruce or Hanif, we also will give them the mic so they can respond to you. Okay, can I just give a quick process on the Q&A? What we like to do is have you put your hand up and we'll deliver a mic to you so everybody in the room can hear you, and a mic is on its way.
Very good talk. Ari, I wanted to ask you from a research perspective, have you done much research on the return on Canadian small cap companies as a discrete asset class?
So do you mean, so public small cap
Yes.
returns? So we have looked A little bit, and the problem is data is always tough to find on this, particularly if you're looking at the venture exchange. But it seems to be, when we look at, for example, the CPC program, it seems to be that the founders do very well, and people that buy into that space do very well until they graduate. But then, from the point where they graduate onward, they seem to not be doing as well as, say, a company that's a regular TSX venture IPO. That lists on the venture and then trades there for a while and then graduates eventually. So it looks like the small cap space, in some senses, looks good, but in other senses, it's not great. But that's not a symptom of just Canada. I think small cap IPOs, for example, have underperformed, and that goes in the U.S., in Europe, and other markets as well. So that's part of the reason why maybe you're seeing small cap IPOs disappearing, is because investors actually haven't fared as well as they would have hoped. So long run returns tend to be quite negative, actually, for small firm IPOs, for example. In the venture capital space, Michael's probably got quite a bit of experience from his firm's perspective, but when you look at research, private equity generally is negative returns. So the classic thing is you invest in 10 startups, 8 or 9 of them fail, and then you have one home run that sort of makes up for the rest of them. So you have a lot of skew in the data if you look at the returns in the private space. So public markets, small cap companies don't fare all that well if you look at their long run returns. And in the private space, it's very skewed. So you have a couple of home runs and then a lot of them end up failing, which is not surprising. I mean, that's the nature of venture capital, right? You take some risks in that process and you're hoping for that skew, the right-hand side of the distribution, essentially.
If I could just ask one more thing. I think that one of the things we all have to do in terms of the public markets and the return on small caps is get more data. I met with Steve Palmer of Alpha North, who probably not a lot of people in the room have heard about. He's claiming he's got an 18% year-over-year return on about a 15 to 20-year sample size of small cap investments. And I think we've got a world-class stock exchange here in the venture exchange. And I think personally in Canada, we have a tremendous concentration of capital, particularly with the big banks dominating the ecosystem. People invest in what we know. And what I'd like to see is more research from academia coming out, because I think the returns on small caps, when you actually get drilled down, are better than people expect. And I think we need to publicize that as a discrete asset class if we're going to attract more people to the public markets.
Yeah, I agree. And that's my bread and butter when it comes to research. But data is very, very difficult. It's not like the US where you've got tons of data at your disposal. There's a lot of man hours involved in collecting data when you're trying to do Canadian research. So we've got armies of RAs trying to help us with that process. So it is quite time consuming in that sense. But I agree with you. I mean, we need more research definitely in that space.
Michael, do you have anything to add?
No, I thought you did a great job.
Okay. All right. Other questions? Okay.
Thanks very much. Great talks. We've talked about diversification. Ari, do you have stats sort of taking out the resource sector out of those curves? So we have sort of the resource volatility out of there?
So looking at the IPO levels in non-resource plays. So I do have data on that. I can certainly produce it. It turns out to be the case that the Canadian market is much more resource oriented. So if you do look at the IPOs, I mean, a good proportion of them are resource-based in Canada, and it's just the nature of our marketplace. Off the top of my head, I can't remember what the numbers are, but I can certainly easily produce those numbers. But I would say historically, non-resource IPOs haven't been great either in the Canadian context, and we've certainly seen a drop-off in those as well.
Do you have a rough feel of percentage that were resource versus non? Just
I'm inclined to say about 60% might be resource-based, but I'd have to verify. Don't quote me on that if there's any media people.
I think a lot of that would be time sensitive because over the last few years, I think as most of you would know, there's been very few IPOs on the resource side. And I think as Bruce would attest, a lot of the reason for that is when I was involved in the oil and gas business 20 years ago, you could raise $5 million and turn that into a very successful oil and gas company. And now that number is probably $50 million to $100 million. So you just don't see the small IPOs on the resource side any longer.
Although on the venture exchange you do, I guess, and that's been sort of a big selling point for resource companies. And that goes back the history of Alberta and Vancouver stock exchanges. that existed. So that's definitely very resource driven. If you look at the TSX Venture and the IPOs there, 80 to 90% of those are mining and oil and gas plays for sure. In the senior market, less so, but still a large chunk of them are resource based as well.
Okay, we have a question at the back.
So in what seems to be an era where the social impact and the environmental impact and the focus on a company's sustainability and the ability for a company to deliver on that seems in contrast to this 90-day report card that is in the public space. And how do we reconcile that? And especially in the resource space, I mean, I think that's what we've faced in the last 2 years, is that we couldn't adapt to this changing world around us. And it was really the investors that were driving management teams to make erratic decisions and moves that did not have a long-term view to it. And I get it as a business owner myself, but so it makes me very fearful of a prospect of looking at an IPO where all of a sudden I'm now going to be judged on such a short-termism thinking. And what's your view on that? I heard nothing. Maybe it was in the talk, but I heard nothing about it. And it seems to be our greatest issue in the public markets in the Western world.
So can I jump in there first? Yeah. So maybe I didn't say it well enough, but that public market pressure hypothesis that I proposed is exactly that point, where we've created an environment where managers are so concerned in the public space with keeping shareholders happy, particularly short-term shareholders. And you're right, this quarterly reporting creates even that much more pressure, where you're trying to keep analysts happy, you're trying to keep short-term, often hostile and activist shareholders happy, that you're losing sight of the long term. So the hypothesis that we come up with in that paper of ours is exactly that the public market space is being so hostile and difficult to operate in, where presumably CEOs and founders got into the business of running a business, but they're not even running a business anymore when they're in the public markets. They're dealing with all these external forces that exist. And that's why when you looked, well, I didn't have it in the slides, but there was this Fortune survey done of CEOs, and they were asked, do you find the public space hostile, and would you run your business better in the private space? And over 75% of them agreed with that statement. So I think that's bang on to the point you're making, is that we may want to move a little more the other direction, where we have management focusing on business rather than all these external gatekeepers that exist. And I posed that to you, and I thought you agreed with that as well.
Yeah, for sure. I think the other thing to keep in mind is that as well as shareholders' requirements for sustainability within companies, the governments are far more impactful on regulations now than they were 10 and 20 years ago. I was talking to a gentleman that's doing some approvals for changing a mine, and he said 10 years ago those approvals would have cost $300,000, and now it's $1.5 million. So government regulations within the mining sector, within this abandonment liability with LLR regulations, things like that, there's huge changes within the whole sustainability of especially resource companies.
Okay, I think we have two last questions already kind of identified. There's one right here.
Sure. I'll start with maybe a general comment that an opinion that the Ontario Securities Commission really doesn't understand or want to understand small companies, given that they're late to the game on CPCs and the offering memorandum. Given that there's a push to a national securities regulator, and I'll call it the OSC, two-part question. Do you think that the provincial government has traded pipeline approval for a national security regulator? And also, would that impact the IPO market?
Pretty politically charged question. This is where
you have your
I can
crystal
deflect.
ball. Yeah.
I think you should answer this.
Yeah, that's right.
I think the two are pretty separate. Alberta's always been fiercely independent about having its own IPO market and the ability to sponsor small companies through the IPO process. And also we are very, not only Alberta, but Canada really needs pipelines. So I think the government would view them separately, and I think they would strive to achieve success in both areas.
The one thing I would add is I agree that one of the benefits of having different securities commissions, I'm not taking a stand on on either side, is exactly that, where you can sort of tailor regulation to the needs of the province and to the industry that operates there. So you mentioned two really good examples, the OM exemption, where Alberta was an early adopter of that, and Ontario just recently adopted that. So that was a sort of a made in Alberta solution. And the CPC program was also something that started here. And that was really smart regulation. So if you look at some of the history of that, these blind pools actually were around in the US, and it led to some severe fraud there. So these guys from Colorado and Utah sort of made their way up to Alberta and started doing it here. And the first few actually led to significant fraud in Alberta. But instead of sort of putting a halt to it and saying this isn't going to fly in Alberta, the Securities Commission at the time was really astute. And they said, okay, we'll just put some proper regulations in place. So they put, it was called the JCP program there. They put some really good governance regulations in place. And basically the market took off to the point where the Vancouver Stock Exchange started losing listings to the Alberta Stock Exchange. They adopted it, and then subsequently the other provinces adopted it because it was seen as a big success. So, I mean, that's one of the benefits I would say of having the separation, but of course there's benefits to having the national as well. So, I think you just need more research done on that more than anything else to see what might make sense and what might not make sense.
Okay, one last question. I think it's right there.
Thanks very much for the presentation. I really enjoyed it. I had a question about if your perception of the value of the public markets would change if part of the business model was to be acquisitive, to buy companies.
Well, I think a lot of public companies, that is part of their mandate. You're saying, with a public company trying to buy other companies, would the perception of value change?
Yeah, for accretive acquisitions.
Sure. Yeah, I think part of the mandate of many public companies is to try to acquire other companies. And Ari may know the stats, but as you probably heard, a lot of the acquisitions that companies do are not, at the end of the day, accretive. They look good on paper. Of the ones that I've done, probably half have worked out well and half haven't within acquisitions. So I think it's part of the mandate, and I think when they're successful, obviously the value of the company increases, and when they're not, they drop. So prudent management groups will be looking at that as a method of adding value in the future.
Yeah, I think if you look at academic studies, acquisitions, at least from the acquirer's perspective, don't often turn out to be really good investments. So there's large literature that shows poor performance. Part of it is a lot of companies end up overpaying, or they don't see the synergies that they thought they might have seen. But yeah, there is some research that says companies go public, and soon after they're either acquired or they do an acquisition. That's one of the benefits of being a publicly listed company, is it allows you that currency to actually go out and make an acquisition, or it gives you a bump up where if you do want to get acquired, it gives you a better price at which you're going to be acquired. So there's certainly research that supports that.
Again, my theory is that if you have a good management team with good ideas, you can access the funding. On a marginal basis, yes, if you're public and you want to do an acquisition and you've got strong followings, it may be easier. But if you have strong private backers, as Bruce or Hanif would tell you, and they have deep pockets and you come up with a good idea, they're going to fund it. So I wouldn't necessarily say that it's de facto easier if you're public.
So just to add to that, I mentioned Jay Ritter, who's sort of the IPO guru in the US and globally. So he's got a paper also, Where Have All the IPOs Gone, really focusing on the US market. And that's his hypothesis, is private companies are selling out rather than going public. And it's because a lot of small companies just aren't profitable. So a better model is them to sell out to a Facebook or a Microsoft or an Apple, who have large supply chains, can gain economies of scale and economies of scope. So a lot of entrepreneurs are selling out in the private marketplace. And from the acquirer's perspective, they might want to do that rather than let this company go public and buy them where they might be paying a higher price for that. So that's a hypothesis he has, and he has data to support that, at least in the US. But really applies, I think, more so in his study to the technology sector, not necessarily to the Canadian market where we have a lot of resource type companies.
Okay, my professional timekeepers tell me we have time for one more question, if there is one more. Okay, Harry.
The venture exchange has gotten a lot of bad press in the last year or two, and a lot of dead companies sitting on their shell companies in the mining and resource sector. So I was a little bit surprised, Ari, to hear your positive spin on the venture. So maybe could you just say why?
Yeah, so you know, if you look at the history of the venture exchange, it's hit hard times before, right? So in my view, it's a little bit of a cyclical thing going on, where, I mean, resource prices have been down, and not surprisingly, you know, the venture exchange is highly resource driven, and certainly you're going to see a drop off in the number of IPOs, both at the regular IPO level and the CPC level. Now, I think, you know, as you start seeing resource prices come back up, you're going to see a pickup in that. I think that's where, if you look at the venture exchange, they put a white paper out where they made some changes. I think part of what they should be doing, and they are doing, is looking to diversify the venture exchange. And I think part of that is awareness. You know, like I said, you know, I've raised it in my class, both undergrad and MBAs. You know, do you know anything about the venture exchange? And a lot of people aren't aware of it, right? So if you're a non-resource company, there could be benefits to you in listing on the venture exchange. And I think it's more awareness. You know, letting students know, going out, telling the story of a lot of the successes that have existed. So, you know, Boardwalk Properties was an example that started out as a CPC, listed there, and eventually listed on senior markets and did very, very well. There was an example of a Silicon Valley company, Frankly Inc., that actually came up and listed on the venture exchange and turned down venture capital in the US. So there are these anecdotal stories, but I think just a lot of people don't know about it. And I think part of ensuring the success of the venture exchange is allowing that to diversify, where it's just not focused on the resource sector, and you're allowing other types of companies that are coming in. And as I said, I think the venture exchange has been really good, and as well as the commissions, in adapting to the times. So changing rules as times are tougher, to make it easier for companies to go public, but at the same time making sure that investors are protected. And I think the exchange and the Securities Commission here in Alberta has done a really good job of finding that balance. So my thought is that you'll see an uptick again, but time will tell, I guess.
Thank you.